Hi everyone, my name is Luis Orbescience. Welcome to our training session on corporate financial management. Today, we're going to explore how our organization evaluates new projects, specifically focusing on how we use sensitivity analysis to account for real-world risk before committing capital. To understand capital budgeting, we have to start with the core goal of financial management, which is maximizing shareholders' wealth. While maximizing short-term profits sounds good on paper, wealth maximization is about building long-term sustainable value. This means looking closely at actual cash flows when that cash comes in and the level of risk we take on to get it. To achieve this goal, financial managers focus on three main areas. First is working capital management, which keeps our daily operations running smoothly. Second is our capital structure, where we decide on the right mix of debt and equity to minimize our costs. Lastly, and our focus today, is capital budgeting. This is the process of deciding which long-term projects or assets are worth investing our capital into. Build out our quantitative framework, our textbook author Robert Irons defines sensitivity analysis as a technique designed to see how our financial outcomes change when we alter a single input variable. When we evaluate a project, we always start with a baseline financial model using our best estimates for net present value and internal rate of return. From there, we alter just one variable at a time. For example, we can drop sales by 10% or raise raw materials by 5, all of this while holding everything else constant. This shows exactly which variables have the biggest impact in our project's financial success. Numbers don't tell the whole story. We also have to integrate qualitative steps into our risk analysis. This involves assessing how a project impacts our brand reputation, how competitors might react, and how shifting customer preference could hurt demand. We also have to look at potential regulatory changes and ensure the project aligns with the overall strategic vision. Internally, we have several financial tools to handle risk. Instead of using a corporate WACC for every project, we can use risk-adjusted discount rate. If a project is riskier than our usual operations, we'll raise the internal hurdle rate it must clear. We also expand our sensitivity models into a scenario analysis, where we change multiple variables at once to see the best case and worst case outcomes. Finally, we have to look outside our company walls. External financial methods involve tracking macroeconomic pressures like inflation and shifting interest rates, which directly impact our borrowing costs and the market risk premium. By combining these external market realities with our internal sensitivity models, we protect the organization from investing in projects that look great in the spreadsheet but can't survive a changing economy. This concludes our training session. This reference reflects the foundation financial theories behind capital budgeting and risk integration that we discussed today. Thank you for all your time, and let me know if you have any questions.